Thanks so much for joining us today to talk about the Clean Vehicle Tax Credits. My name is Ingrid Malmgren, and I'm the Policy Director at Plug-in America. We've got a lot to cover today, so I'll just jump right in. So my goal today is to help you understand more about the federal EV tax credits. So I'll quickly go over what we do at Plug-in America, and I'll provide you with the updated guidance on tax credit information for new clean vehicles, used clean vehicles, and commercial clean vehicles. I'll give you some resources, and then I'll open the floor to questions and answers. So Plug-in America is a nonprofit. We work to educate consumers, policymakers, car dealerships about EVs. We host Drive Electric Earth Day and National Drive Electric Week. We operate plugstar.com, which is an online EV shopping tool. And we answer questions through our EV program support helpline and email. So a little quick housekeeping. This guidance was published on December 29th, 2022 by the Department of Treasury and the IRS. If you're interested in getting to this additional guidance, you can just Google Treasury Clean Vehicle Provisions and it'll pop up. And a disclaimer that I'm not a lawyer or an accountant, and so this is as accurate as possible given that there's a lot of unanswered questions and that the Treasury the guidance can change at any time. So quick background on EVs. These tax credits apply to fuel cell vehicles and electric vehicles, but in this presentation, we're just going to focus on EVs. An electric vehicle is basically a vehicle with a battery and a plug, which can be charged from an external source of electricity. So a battery electric vehicle, as shown on the left, is all electric. There's no gas and no internal combustion engine. A plug-in hybrid electric vehicle has a gasoline engine plus an electric motor and can be externally charged. It typically runs on the electric battery for a certain number of miles and then switches over to a range extending gasoline engine. So collectively, I'll refer to them as EVs in this presentation. So let's start with the three types of clean vehicle tax credits that are part of the Inflation Reduction Act. There are tax credits for new clean vehicles, previously owned or used clean vehicles, and commercial or business clean vehicles. 30D, which is the name of the tax code for the new clean vehicle tax credit, has been around for a while. And the Inflation Reduction Act extended the tax credit with some changes. The used and commercial tax credits are both new and went into effect on January 1st. So there are a few rules that apply across the board to be able to take advantage of these incentives. So there's one credit per vehicle, which means there's no double dipping. Taxpayers have to include the vehicle identification number on their tax return. The vehicles must be made by a qualified manufacturer. That means a manufacturer who enters into an agreement with the Secretary of the Treasury and provides reports providing information to the Treasury. The vehicles cannot be acquired for resale. They must have a gross vehicle weight rating of under 14,000 pounds. That basically means that's the weight of the vehicle empty, passengers, cargo, and accessories. So basically the safe operating weight of the vehicle. The vehicle must be propelled by an electric motor, which draws power from a battery of at least 7 kilowatt hours and must be able to charge from an external source of electricity. And the vehicle must be manufactured for use on public streets, roads, and highways, and have at least 4 wheels. So the last three, there is an exception, and that's the commercial clean vehicle tax credit, which also has credits for vehicles over 14,000 pounds used for business purposes. And they have access to a $40,000 tax credit. The battery requirement is 15 kilowatt hours, and it also includes mobile machinery that can be used off-road for mining and farming. So let's get into the details of the new clean vehicle tax credit. So there's some big differences between the old EV tax credits and the new ones. In order to be eligible for the new clean vehicle tax credit, the vehicle and the purchaser have to meet the criteria in the left-hand column on this slide. There's MSRP caps and final assembly rules for the vehicle. Meanwhile, the taxpayer must meet income limits. In the Inflation Act, the new clean vehicle tax credit amount is split into two parts based on battery sourcing requirements, including critical minerals and half for battery components. But based on the interim guidance that was provided by the IRS on December 29th, the battery sourcing requirements will not be in effect until the IRS issues additional guidance, which they expect to do in March. So until the IRS issues additional guidance, the tax credit amount will be based on the battery size, as it has been in the past. Currently, all battery electric vehicles in the US market have a large enough battery to qualify for the full $7,500. All plug-in hybrid vehicles will qualify for the minimum of at least $3,751, and most will qualify for more. So here's the timeline of the new clean vehicle tax credit. The guidance we are discussing today went into effect on January 1st of this year and is expected to change in March when the IRS plans to issue proposed guidance on the battery sourcing requirements. Once the proposed guidance comes out in March, it will go into effect immediately. Another thing to note on the new clean vehicle tax credit is that the 200,000 vehicle manufacturer cap has been eliminated. This means that Tesla, GM, and Toyota vehicles are once again eligible for the tax credit, assuming they meet the other requirements. So in summary, between January 1st and March, to be eligible for the tax credit, the taxpayer needs to meet the income limit and vehicle needs to meet the MSRP caps and the final assembly requirements. For this brief period of time, the tax credit amount is based on the battery capacity, but expect this guidance to change in March. So now let's look at the used EV tax credit, which just became available January 1st. So the requirements for the used EV tax credit are that the vehicle must be at least 2 years old and must cost under $25,000, and it must be sold by a dealer. The purchaser has to meet income caps, and the credit amount is $4,000 or 30% of the price of the vehicle, whichever is less. There are no additional sourcing requirements for the used EV tax credit. There's no critical minerals, battery components, or final assembly requirements. The guidance for the used EV tax credit became effective January 1st and is expected to be in effect until the tax credit expires in 2032. There is some additional details about the used EV tax credit, but there are no final assembly requirements and there will not be any battery sourcing requirements for these tax credits. So finally, let's talk about the commercial EV tax credit. The commercial EV tax credit has fewer restrictions than any of the other tax credits. It's required that the vehicle must be made by a qualified manufacturer and they must be used for business purposes. The credit amount is 30% of the sales price for all electric vehicles and 15% of the sales price for plug-in hybrid electric vehicles, or the incremental cost. So incremental cost is the cost difference between the clean vehicle and the comparable gas-powered vehicle. The credit cap is $7,500 for vehicles less than 14,000 pounds and $40,000 for vehicles over 14,000 pounds. The commercial clean vehicle tax credit guidance I'm talking about today also became effective January 1st and is expected to be in effect until the credit expires in 2032. Unlike the new consumer clean vehicle tax credit, the commercial clean vehicle tax credit has no battery or mineral sourcing requirements, no final assembly requirements, no MSRP caps, and no income limits on taxpayers. This means that a business could purchase electric vehicles that don't meet some of these requirements and lease them to consumers. From a consumer perspective, this may offer opportunities to access tax credits for vehicles that might not otherwise be eligible, and if their income does not meet eligibility guidelines under 30D. So here's a summary that shows the 3 different types of tax credits and which criteria apply to each one. And this is available on our website if you'd like to reference it later. So what's next? So expect the requirements for the new clean vehicle tax credit to change in March when the IRS issues proposed guidance on battery sourcing requirements. We don't know which vehicles will be eligible or what this guidance is going to look like. Not much is expected to change with the used EV tax credits or the commercial EV tax credits. If you're interested in purchasing an EV, a new EV, plan to take delivery before the new guidance is released. That's one of the key takeaways. So there's a unique window of opportunity between now and March that doesn't include the battery sourcing requirements, and it might be a great opportunity to get an EV sooner rather than later, because we really aren't sure what's coming or what the tax credits will look like for the new clean vehicles. The second key takeaway is that leasing might be a really great option, a workaround to some of these requirements, but there's no guarantee the full amount of the tax credit will be passed on to you. So pay attention and talk to your dealer if you're interested in leasing to make sure this tax credit will be passed on. The third key takeaway is that the used clean vehicle tax credit doesn't have a ton of requirements. So if you meet the income limits and the cost cap, this could be a great way to get into an electric vehicle. And then finally, check the IRS website to find out which vehicles are eligible and the MSRP limits of those vehicles. Be sure to compare that with the MSRP of the exact model and trim level of the vehicle you plan to purchase to make sure that the vehicle you purchase qualifies, because the guidance on the vehicle classifications and MSRP caps, it's not very intuitive. It's quite confusing, actually. So definitely check the website before you make assumptions about whether a vehicle, particularly a vehicle like a crossover, is either an SUV and qualifies for the $80,000, is subject to the $80,000 price cap, or is a regular car and is subject to the $55,000 price cap. Here's some resources. The IRS manufacturers and models page is where you can look that information up. The VIN decoder will show where your vehicle, the final assembly was for the exact vehicle you're interested in purchasing. And then Plug-in America has a tax credit resource page with all of this information and a lot of frequently asked questions. Plugstar.com also includes state and federal incentives, and feel free to call our EV support program.